So let's continue our journey on current liabilities and look at another example. So here we've got Mossy Bottom Baskets began operations in October of 2018. The following selected transactions relate to the liabilities of the company for October of 2018 through March of 2019. Mossy's fiscal year ends on December 31st. Its financial statements are issued in April. So here we've got a listing of the transactions for 18 and 19, and it says prepare the appropriate journal entries for 2018 and 19 transactions, and then prepare the current and long-term liability sections of the December 31st, 2018 balance sheet. Trade accounts payable on that date were $257,000. Then it lets us know that the template's on the next page. So let us begin by looking at each of these transactions and seeing how we would journal them. So in 2018, on October 5th, they opened a checking account at Mistaken Bank and negotiated a short-term line of credit up to $22 million at the bank's prime rate, 15.5% at the time. The company will pay no commitment fees. So on October 5th, what entry would we need to do to show this line of credit? Well, a line of credit, while it's important because it may allow us to operate in times of cash flow issues, it's really not a journalable event. It really has no entry involved simply because we haven't increased liabilities at that point. We've increased our access to cash if we need it, but we haven't increased our liability. So it's really no event there. So now let's look at the next one. On November 1st, we borrowed $19 million cash from Mistaken Bank under the line of credit and issued a 5-month promissory note. Interest at the prime rate of 15% was payable at maturity. Management planned to issue 10-year bonds in March to repay the note. So again, we're going to borrow this on a short-term line of credit, and then we do anticipate next year that we will, in March, go ahead and refinance that using bonds. So what entry do we need to make effective November 1st? Well, we actually borrowed the funds, so we're going to receive cash of $19 million. And then we need to credit our notes payable because we borrowed those funds on a line of credit. So notes payable for $19 million. Moving on. Received $3,200 of refundable deposits in December for reusable containers used to transport and store chemical-based products. So again, a deposit simply means that, hey, I'm going to give you this product, but once you bring the product back to us, we will actually refund you the deposit. So when we receive those deposits, I'm just going to put December here, we do actually receive cash. They pay us the deposit. Now, is it revenue to us? Are we actually selling the containers? Absolutely not. We're basically letting them borrow the container, and we're just holding their money in case they don't return it, so that way we don't lose money on them. So this is actually a liability because we're at this point anticipating that they will actually return the container to us. So we're going to hit a liability, a refundable deposit type of account to show that we may end up having to pay those funds back. Now, if they ever expire, we would then record them as revenue. But at this stage, we owe them. There's full anticipation that they will be returned, and we will have to refund that deposit. So it's a liability to us. All right, next. For the October through December period, sales on account total $4,900,000. The state sales tax rate is 3%, and the local sales tax is 3%. This is a summary journal entry. So in other words, it's everything for that period we're going to summarize into one entry. I'm just going to put December because that's where we're at, but it's a summary sales entry. The sales on account were $4,900. So that tells us we need to debit our accounts receivable to actually increase the balance there for the $4,900,000. Then what are we going to credit to offset it? Well, in this case, it would simply be sales revenue, $4,900,000. Now, wait a minute. What are we missing in this transaction? Well, anytime we have sales, what must we also record? Well, in a state that has sales tax, we must then recognize sales tax as payable. Now, the sales tax is a current liability to us. It doesn't benefit us. What we end up doing is we're going to collect those sales taxes from our customer and then turn around and send it to the proper state agency. So before we can actually record the amount that our customer owes us, we need to look at how much would the taxes be. Well, it does tell us that it's 3 and 3, so it's a total of 6%. So the easiest way would simply be $4,900,000 and multiply that by the 6% to calculate the sales taxes payable. So what do you get when you do that? Well, you should get $294,000. Now we need to update the accounts receivable, that 4.9, to include that actual sales tax payable. So if you add 4,000,009 to the 294,000 there, you end up with 5,194,000. So that's the amount we would actually record as accounts receivable. So make sure when we sell a good where there are sales taxes that we do take that into account when recording the entry. All right, very good. Now the last one is to record the adjusting entry for accrued interest. Now we shouldn't need to be told to do this. We should know that if we have an interest-bearing position and we cross a year in, we need to actually accrue the interest that is owed, so to speak, on that note. So do we have any of those? Well, absolutely. Remember, A was non-event. That $22 million is a line of credit, but when we borrowed against it on November 1st, we did take out an interest-bearing note. So we're going to have to accrue the interest expense that would have accrued between November 1st and December 31st. Now we do not have to pay that interest until next year, so instead of hitting cash, we're going to actually hit interest payable there to show that accrual. Now how much? Well, we need to go in and calculate the interest expense. And again, an easy way to do that is PERT, principal, times rate times time. So PRT, or PERT. So the principal again is our 19 million. We're going to multiply that by the actual rate on the line of credit, which is 15%, and then we need to multiply that by time. Remember, interest rate is always out of 12 months. So then we have to ask, how many months have accrued? Well, in this case, it was all of November and all of December, so we're going to have a 2-month period out of the possible 12 months for that 15%. So we won't owe a full 15% yet. So when we multiply that out, you should get 475,000. So that's the amount we're going to record in our journal. So that concludes our interest portion of our calculation. Now, let's move into the next year to see what happens. In March, we issued $4.5 million of 10-year bonds at face value and paid the bank loan on April 1st, on the April 1st due date. So we did at this point actually issue additional bonds to cover that line of credit. So in March, we need to record the actual bonds. And if you don't want to put March, you can say that this is F. When you go through the letters, that's fine as well. So first, we need to issue bonds, and we issue them at face. So when we issue bond, typically we're going to receive cash for the value of the bond at that time. Again, that's stated at face value, so we're going to charge that at $14.5. That's the amount of cash we would receive. Then we need to credit the bonds payable. Again, this is a long-term debt position, but we do need to show that those were issued in order to pay off our current liabilities. Now, let's go in and pay off the bank note. Well, there's a few things going on with the bank note. First and foremost, when we remove the note, we have to remove all the evidence of the note. So one thing we're paying off is the interest payable that we accrued last period. So if we go, notice on this note, we accrued $475,000. Well, when we pay it off, we're going to pay off that $475,000. Then, has any additional interest accrued from the last accrual date of December 31st and the payment date now in March? Well, absolutely. So we need to record additional interest expense. And actually, let me rephrase, we're paying this off on April the 1st. So we need to accrue the additional expense through April 1st. So we need 3 months of interest. Remember, this was 2 of the 5. So now we need to accrue the other 3. So we're going to take that full 19 million. We're going to multiply it by the 15% and by 3 out of 12 because we're accruing 3 months of interest. And we multiply that out, you should get 712,500. Again, that would represent 3 months of interest that has accrued on this note. So 19 million times the 15% times 3 divided by 12. So the total interest on this note would actually be $1,050,500, I think. So you would add these two together, and that would sort of give you the amount of total interest. Let me rephrase that. Let me add those together and see. It's $1,187,500 to be exact. Okay, so when we add that, that's the total interest, or 5 months worth of interest. Now, what else has to happen? Well, again, we have to remove all evidence of the note, so we need to get rid of the note payable, which we had recorded at 19 million. And then finally we paid the note off, so we would have to hit cash, and cash would be the actual maturity value, which would be the total principal, $19 million, plus the total interest, the $475 and the $712,500, which would come out to $1,187,500 in total. And then the last thing that happened, let's look at G. And again, you can do G or you can put March. Half of the storage containers covered by refundable deposits were returned in March. The remaining containers are expected to be returned during the next 6 months. Okay, so again, half of those containers were returned. So let's look back. Originally, we had 3,200. So if half of those are coming back, that means $1,600 worth are coming back. So on refundable deposits, when they're returned, what we need to do is reduce the liability because we no longer owe these deposits back to our customers, and it would be half of the 32, so $1,600, and then we actually have to pay those deposits back out in cash. So we're going to go in and we're going to credit our cash for that same $1,600. So that's how we would journalize each of those transactions. Now requirement 2 says, okay, now that you have that, produce the liability section of the balance sheet. Now the liability section is going to have two components. One will have current liabilities and we'll have non-current or long-term liabilities. So let's go through and find what the current liabilities are. Well, one, it does tell us in the problem that we had trade accounts payable, so we've got accounts payable of $257,000. So accounts payable are current liabilities, so we would list them as a current liability. Now let's go through each of the line items and see what we have. Well, as of December 31st, now remember this is as of December 31st, that date, would we have this note of $19 million? Absolutely. Now we have to ask, is this a current note or a long-term note? Well, the answer is a little bit confusing because remember, in March we actually did issue bonds of $14.5 million to actually pay off the debt. Well, those $14.5 million in bonds were not enough to cover the full debt. So the bonds payable piece, the $14.5 million, that's considered long-term. So of this $19 million, $14,500,000 would be reported as a long-term liability. Excuse me. So that remaining balance, what's left, would actually have to be carried as a current portion. So the $4.5 million that's remaining would be a current portion of long-term or non-current debt. Okay, so long-term note, and that would be $4,500,000, and that portion we do plan to pay off. The remaining balance, the $14.5 million we're issuing bonds for, would definitely have to be long-term because we know about it before the date of the publication of our financials. All right, it's a subsequent event, so we know it's going to happen. What else? Well, the next thing we've got is this liability for refundable deposits. All of those are current because we do anticipate that they will be returned within the current period, within the next year. Now remember, we put $3,200 on, so that's what we would actually carry that account at because none of them have been redeemed. They were redeemed next year. So that would be $3,200 that we would need to put there. Again, remember our balance sheet date here is December 31st, 2018. So anything due within 1 year of that date. All right, the next thing, will we have to pay these sales taxes payable at December 31st? Absolutely. Governments are not going to wait over a year, so sales taxes are current liabilities to us. So we're going to go in and do a current liability of $294,000 there. All right, anything else that's a current liability? Well, the last thing would be the interest payable. Remember, that's due on April 1st, so as of December 31st, that interest would actually be a current liability, so $475,000. So we've taken into account everything except for the long term. Under our long terms, we're going to have the one additional, and that's going to be the bank loan refinance. We haven't issued the bonds yet, so we do not want to go in and actually record it as a bond payable, but we do want to make note that we are planning on refinancing that at $14,500,000 in subsequent period. Okay, and that will definitely be done prior to issuing our financials, so we have to record that as long term. So that would be how we would represent it on our balance sheet. The current portion would look like this, the long term with the 14.5.